In this problem, we'll take a look at the treatment of manufacturing overhead. KA Catering uses a job order costing system to assign costs to its catering jobs. Overhead is applied to each job based on direct labor hours. Listed below is data for the current year. Budgeted overhead cost, $90,000. Actual overhead cost incurred, $77,000. Budgeted labor, $100,000 for 10,000 hours. Actual labor, $95,000 for 9,000 hours. So you can see that we know both what we thought would happen and what did actually happen in this problem. Determine the amount of overhead applied to work in process during the period. Well, there's two things that you have to do in order to get this number. First, you have to compute your predetermined overhead rate if it's not given. It's not given in this problem, so recall that the predetermined overhead rate is computed by taking budgeted overhead cost divided by budgeted activity. In this case, budgeted overhead cost is $90,000 and overhead is applied based on labor hours, so we'll divide by the budgeted labor hours, or 10,000. We'll get $9 per direct labor hour. So every time a direct labor hour is paid, they'll get paid their wage rate, and we'll record that, but we'll also estimate that $9 worth of overhead costs should be incurred. Now we can apply overhead using the formula overhead applied is equal to overhead rate times actual activity. We actually worked 9,000 hours, so we'll take $9 per direct labor hour times 9,000 hours actually worked. Overhead applied is $81,000. This is the amount we will assign to work in process inventory as our estimate of the overhead costs that should be incurred. Show the adjusting entry to close the overhead account at the end of the period. Well, we need to first determine the balance in the overhead account. The easiest way to do that is to set up the T account for manufacturing overhead. Recall that actual overhead costs go on the debit side, applied overhead costs go on the credit side. So we're given that actual overhead cost is $77,000. We computed applied overhead to be $81,000. Notice that the budgeted overhead never gets recorded in the books. It is only used in the predetermined overhead rate calculation. This gives us a credit balance of $4,000 in the overhead account. This means that we assigned too much cost to inventory, or we over-applied overhead. The journal entry to close this overhead, if you have a credit balance in overhead, you're going to need to debit the manufacturing overhead account. And assuming this amount is immaterial, we will close it to cost of goods sold. Notice that cost of goods sold is an expense account, and we're reducing it with a credit. Since we over-assigned cost to inventory, we are now reducing cost of goods sold. Assume two jobs were sold during the period. Job 10A costing $200,000 and Job 12B costing $100,000. What is the cost of goods sold before adjustment? What is the cost of goods sold after adjustment? Well, before adjustment, we will simply add the cost assigned to Job 10A of $200,000 to the cost assigned to Job 12B of $100,000, so cost of goods sold before adjustment is $300,000. Cost of goods sold after adjustment, you'll need to take the $300,000 and adjust for the over-applied overhead. And since over-applied overhead indicates you assigned too much cost to inventory, we will reduce cost of goods sold, and cost of goods sold after adjustment is $296,000. That's it for this problem, so be sure to get plenty of practice and ask questions if you have them.